This is Brad Brain. I'm here with Alec MacIsaac, who's a portfolio manager with Antares Investment Management. Alec runs the total equity mandate with Antares, which is a component of the Prosperity Fund. Now, Alec, I just had an experience a couple days ago. It kind of put things into context for me. I had a few phone calls on the same day. And the reason I got these phone calls was because some people had just gotten their statements, they saw the results, they thought it was worth checking in on. And you know, you and I, we live this on a daily basis. So I think it would be easy for us to overlook the concerns that clients could have. Because in my mind, I didn't see the same piece of paper that they saw. This came from somebody else. Our office didn't send them this. So I don't have in front of me what they have in front of them. And they're describing it and they say, we're down 9%. And I'm thinking about that and I'm going, God, we just went through the quickest bear market in the history of bear markets. We went down 20% in 20 days, and things didn't stop there. And with that as a background, this particular time frame that they had recorded, it was down 9, and it caused them concern. And I think we can never get complacent about that. Is clients, naturally so, because this is the money that allows them to do the things they want to do. It gives them safety, it gives them security. They will be worried about their money. So in these times, tell us how you are good stewards of money. How do you select stocks?
Very good question, and you're right. Just people are concerned about their investments. We're all getting older. We're all getting closer to retirement, and many clients are retired. So it's very understandable that there can be concern out there. I get that. We've got clients all over the age spectrum, and some are more or less worried, but it's a legitimate thing. It's a real thing, and we care about that as portfolio managers, just as you care about it as financial planner and advisor. So, I guess what I'd say is the world is an uncertain place. I hear a lot, in these increasingly uncertain times, and I suppose there's some truth to that. Maybe there is a higher level of uncertainty, perhaps with, global politics right now, U.S. relations with certain countries, all of that. Maybe that's true, but frankly, the world has always been uncertain. We live in uncertainty, and we have a pandemic today. It's bad. There have been pandemics in the past. People died of plagues for hundreds of years in the past. The world is just uncertain. And so, given that, we operate in that world. And so, and the problem is, of course, is that no one can predict the future with any kind of accuracy. It's luck if you get it right. So we're not in the business of predicting the future. So how then do we manage people's money? Given all of this uncertainty. And so the way we think about it at Antares is we think about the future in terms of scenarios. There are good scenarios, there are negative scenarios, and we try to keep our investment very focused on what matters in the long run. In the short run, any old thing can happen. Like you said, markets can go down 20% more. They can also go up 20% in a short period of time. So let's not forget that. But over long periods of time, to the extent that companies are creating more sales and profits, they tend to become more valuable with the ups and downs along the way. And investors tend to do well, provided they hold on and invest with the proper time horizon in mind. So I give that by way of background. How do we do it at Antares? Well, I sometimes present our approach in terms of imagine a three-legged stool, and each of the legs represents a component of how we think about every business that we add to our clients, your portfolio. So the first leg of the stool is we look at a company's debt. We all know different people out there who have more or less debt, and we know that when debt is high, people can sometimes get into trouble. Right? You can't make your interest payments. The bank calls you up. It's no different for large companies. Some have more or less debt. When you have a lot of debt, it reduces your flexibility when times are bad. So when you have an unexpected recession, right now we have this pandemic, which was completely out of left field, but unexpected stuff happens. Therefore, we want to be ready for it by not having companies that are overburdened with interest payments. They get into trouble. The companies we look for have a moderate level of debt. They can meet their interest payments. When times are bad, they get through it. Sometimes they can buy a competitor that on favorable terms because the competitor has had too much debt and they're unable to meet their obligations. You can take competitors out on advantageous terms. So that's the first leg of our investment stool. The second leg of the stool is we look for companies that have a proven history of generating profits and an ability to pay some of those profits out in the form of dividends. There's all kinds of ways of investing, and some people favor more speculative areas of the market. You know, for example, a few years ago in Canada, a number of people were investing in cannabis shares, and you know, there's different ways of making money. Many people made a fair bit of money in those stocks, and I know a lot of people who lost a heck of a lot of money in them. And the issue there was, you know, there will be winners and losers in this new emerging sector, but it's hard to know ahead of time who the winners are going to be. You want to own the winners. And when a company doesn't have a history, you don't know what the sales are really going to be because it's guesswork. And what happens is these things get bid up to a crazy stock price level, and then the bottom falls out because people all of a sudden realize there's nothing there. You know, the emperor has no clothes. So we buy companies that are established, that have a history of growing sales, profits, etc. So in the portfolio are companies such as Microsoft, Johnson & Johnson, Royal Bank of Canada, just to name three. You know these companies, you probably have some of their products in your medicine cabinet, you might bank with them, you probably use them on your computer. Long history of profits. The likelihood of that continuing is pretty high. That gives us comfort. Okay, the final leg of the stool, of this three-legged stool, is the price you pay for this great business matters. It's possible to have a very good business but pay too much in the stock market, and even though it's a great business, it may not be a good investment. The price matters. And I'll give you a simple example. This might resonate with some people. In 1999, we had the technology bubble in the stock market, all those .com companies. Microsoft was around back then, and their shares did very well in that tech boom. At one point, they were at something like $60 a share, okay? End of 1999. Subsequent to that, over the next 16 years, their sales grew by about 10% a year. Their profits also grew by a similar amount. They initiated a dividend payment as they became more profitable. They didn't hold debt on the balance sheet. Cash grew. They had a lot of good things happening as a business. But the share price, because it was too expensive relative to the profits, did nothing. Well, in fact, it fell initially as the tech bubble deflated. You didn't get your $60 per share back until 16 years later. So imagine that. You're owning a great business, but it's not a good investment. So we need to combine a reasonable price with those other attributes: debt, profits, price. That's how we do it.
Fantastic stuff. Yeah. The strong balance sheet, profitability, and paying attention to the price you get. These are the same things I tell my clients all the time. Yeah. Okay, so now, COVID-19, this has been the story of 2020. How do you see COVID-19 having changed the world?
Well, it's clearly changed the world in a lot of important ways. I'm not a doctor or a medical professional, so the way that I care about is in relation to my clients and my clients' investments. So thinking in my relatively narrow area of expertise, the impact that the coronavirus has had is that it slowed down the economy. It's halted the economy in many cases. And as a result, that has an impact on company earnings or profits. So obviously, if a restaurant shuts its doors for 2 or 3 months, it's not selling anything, it's not making profit, it's probably losing money because it might have rent to pay, it might have some obligations to pay. So it's resulted in a slowdown of corporate earnings. And well, typically stocks go up, over time when the earnings are going up over time. Admittedly, the stock prices can fluctuate around that, but the name of the game is owning businesses that are becoming more valuable. So right now, we have a recession caused by the pandemic. So that's the obvious immediate effect. And so I guess the question, you know, the $64,000 question is when are things going to get better? And that, of course, requires a crystal ball. And I left mine somewhere in the tickle trunk. I don't have a crystal ball. So again, we need to think about the future in terms of scenarios and manage the portfolio accordingly.
Right. But if you tie that back to the first thing we talked about, which is looking for strong businesses, then we could potentially be okay with an uncertain share price for the next little bit.
I think what you say is true, and there are numerous examples in the portfolio that we're managing. In fact, some of the companies are even doing better as a result of the pandemic. An example might be Microsoft, a company I mentioned earlier. It is in the portfolio, by the way. And no, we didn't buy it in 1999. Microsoft, one of the main areas of growth for Microsoft is their cloud business. And the cloud is basically where data that used to be on your computer or on your device or in a server room is now being stored out there, you know, on massive server farms elsewhere. So you can access it anywhere. This is a very powerful long-term force in infotech right now. Microsoft is one of the big leaders in there, as well as Amazon Web Services, and there are other companies as well. Yeah. Well, guess what? With people working away from home and, you know, less access to the office, there's a greater need to accelerate the shift to the cloud. So Microsoft's sales, when they reported their earnings a week or two ago, were robust. Like there was something like, I'm going off memory, but they're 10 or 13% or something like that, which is a big number considering the economy has shut down. That's a big amount of growth. Other companies have had their sales shut down. And so to your point, or shut down or at least slow down a fair bit. And that's normal. This stuff happens. So the question is does it make sense to continue holding them? Maybe you buy more. It's hard to say. And our job is to look at each business on its own merits and do analysis and make a judgment.
Right.
In many cases, we've continued to own businesses where the stock has gone down. In many cases, we've bought more shares thinking that the value of the business is still there in the long run. And so why not take advantage of the weak share price today? It's likely going to be a good investment over longer periods of time. And in a few examples, we've sold the shares because we think that the risk to the business from, you know, arising out of all this is a little bit difficult to quantify, and we'd rather just not risk our clients' capital. We'd rather hold cash or put the cash into a different company.
Yeah. Inevitably, it's the business results that are going to drive the share price. So if you get a good business result, you'll eventually get a good share price, and vice versa. It's like Warren Buffett said, when he buys into a business, he'd be fine if the stock market closed for years, because he's not caring about what the share price does from day to day. He wants a good, solid business that he can hang on to for a long, long time. So given all this, where are you finding opportunities? We talked about Microsoft. You mentioned some other things. Where are you finding opportunities these days?
It's an excellent question. I mean, we're finding it in a lot of places because the stock market, just to kind of build on what you said a moment ago, then the idea of the stock market being shut down for an extended period of time doesn't change what the businesses are doing. The stock market is kind of like an auction. You go to an auction, you're trying to buy a chicken or I don't know, a bunch of whatever it is you're buying. Sometimes the prices go up or down or don't sell because of the psychology of the people in the auction house. So that's what happens in the stock market sometimes, is that rather than the business fundamentals determining the share price, it's the psychology of market participants. When people get overly excited in a positive way, shares can be bid up to very unrealistic prices, like that tech bubble I mentioned a moment ago. Conversely, when people are fearful, they might just sell everything at any price, and that's when you see the bottom fall out of a market. So those create opportunities, to your point. And so given the higher levels of volatility in the market, particularly a few months ago, seems like a lifetime ago, but it was only 3 months ago we were all freaking out, or maybe it was 4, I can't remember anymore. There were a lot of companies where we were turning over rocks and looking for new ideas. And they come from a variety of sources. I'll talk about, maybe I'll talk about 1 or 2 of them, but right now I'll focus on one new company in the portfolio, is one that I think everyone has seen before. It's Otis Elevator Company. So if you've ever gotten in an elevator, often you see the word Otis there. Now there's a few companies out in the world that operate elevators, but it's a relatively concentrated industry. And one of the reasons that there's been some concern about real estate out there. There's been some concern that maybe there will be less construction, and concern that maybe people are going to stay away from offices and work from home. And as a result, there's been concern, you've seen that in the prices of real estate stocks. You've seen it to some extent in the shares of some of these elevator companies. So Otis, one of the things that really attracted us to this company was that most of their profit, if I remember correctly, 80% of their profit comes from maintenance revenue. So it's not building new buildings, it's actually maintaining the elevator. And guess what? You can't not maintain an elevator because the consequences are very bad, right? So the bottom line is elevators are going to be used if they're in a building. They are mandated to be maintained. And because that is such a big part of Otis's business, we believe that even if those bad things happen in terms of real estate, and by the way, just because people are worried about it doesn't mean it's actually going to happen. I have a different view on that, but who knows? They make their money from maintenance. And so it was trading for a very attractive valuation when we purchased it. We added it to the portfolio. We used the psychology of other investors in our favor. At least we think so. Time will tell.
Right. How you started the response there, it reminded me of Warren Buffett's mentor, Ben Graham, and one of the famous things he said, which and that is, in the short run, the stock market is a voting machine, but in the long run, it is a weighing machine. In other words, popularity will determine day-to-day share price fluctuations, but in the long run, it's the quality of the company that will shine through.
Yeah, exactly. The value of the business gets heavier and heavier. It builds, and so it weighs more.
Right. Now, obviously, it's not all sunshine and roses out there. We've got some issues. Where are you cautious of? Where do you see as being a danger zone right now?
Well, I guess, I mean, at the end of the day, we're always thoughtful about where we're going to put money. But clearly, when sales slow down and when the outlook is highly uncertain, you need to be very careful, right? So certain areas of the market that have come down a fair bit in price, where you might think maybe you should look at them, maybe they're interesting, we're not really interested in. An example might be cruise lines or even airline stocks. And the reason for that is that, these are big pieces of machinery that cost an awful lot of money. They have leases to pay on these things, and what we don't know is how quick the pandemic endures. If we've come up with a vaccine that works and get it into people in the coming 6 to 12 months, it may well be the case that people are getting into airplanes or returning to cruises, etc. But it could go on for longer. And so if it does go on for longer, the debt of these companies is going to potentially be an issue. So our view is simply, maybe we don't need to go there. There's plenty of other opportunities elsewhere. Let's go with an area where we have a higher level of conviction. And again, it comes back to that three-legged stool. A lot of these companies just have high levels of debt, and the debt is not serviceable when they're not selling seats. That's a simple example. We have concern. Any area that is sensitive to the economy and where there is a lot of debt in the business, we have some concerns. And that, by extension, that applies a little bit to the lenders as well. So you know, companies like certain banks, for example, whereas, you know, we own a couple of banks in the portfolio, make no mistake, but the change, the deterioration in the economy means that some of the people who have borrowed from them are clearly going to have challenges repaying debt. And with the slower economy, there's just less going on. So it's quite possible that you know, banks are going to have a tough time generating growth in their business. It seems to me that the prospects could be muted. Now, I don't know if that's the case. I hope it isn't the case, but it's, you know, the prospects for growth are lower, in our opinion, today than was the case a number of months ago before this started. And so our view is, well, at the margin, we're likely to put capital in other areas of the market and less there.
Yeah, yeah. You know, I think that's something that potentially there's the perception that what you and I do is simply invest people's money, but a large part of that, it's managing and protecting it as well. And this is the day for Buffett quotes. I guess every day is a good day for a Buffett quote, but you know, one of the things that Buffett famously says is the number one rule of investing is don't lose money. And of course, the number two rule is don't forget rule number one. Yeah.
Well, I mean, at the end of the day, for your money to grow over time, you know, you're going to get a certain compound rate of return. But if you're in the hole very quickly because you've made ill-considered investment decisions, if you've chased a speculative investment and had a permanent loss of your money, for example, some of those cannabis stocks I was alluding to earlier, you're digging from a very deep hole and the math is working against you. If it's a good company that falls in price, but the business is still going along, you're likely to get a recovery and resume the growth. So that's not a permanent loss. It's the permanent loss you want to avoid.
Absolutely. Yeah. Now, we live in different areas of the country. You're in Winnipeg. I'm in Fort St. John, British Columbia. A little bit different local economies. For us, oil and gas is a driving force, especially natural gas. So I'm going to have my perception of it. You're going to have a perception. Let's hear yours. What do you think about the oil and gas sector?
Yeah, very good question. And by the way, I'm an Edmonton boy originally, so I'm very familiar with the oil patch. I'm going to say this. First of all, I find it very intriguing as an area to look for investing possibilities. But I'm also mindful that oil and gas companies in the main, historically, have been relatively bad wealth creators, and many of them have destroyed wealth. And the problem with oil and gas is that you punch a hole in the ground, you extract the resource, you have no control over the price of what you're doing. You got to find another one because it's always depleting, right? So it's a highly cash intensive business. When times are good, costs go up a lot. A lot of them have not made much money over long periods of time, and they always have to go back and raise money in the equity market and the debt market. Not great compounders of capital, but there are some exceptions. And so one area where we have been quite interested is in Canada is the oil sands. Those are very expensive, large-scale operations that were, you know, initially not very profitable, but they've been chiseling down the costs of extracting every barrel of oil to the point where they're doing reasonably well. Well, let me rephrase that. They're holding their own in the market downturn in the tough oil and gas environment. So again, it all comes back to that three-legged stool. We want companies that don't have too much debt. What I really find intriguing just on that point is that a whole bunch of companies already have gone out of business and a number are in the process of going out of business. And, you know, I don't rub my hands together in glee. I feel bad for people who have lost their assets and who've lost their jobs and all that. I've got a lot of empathy for that. But as an investor looking for opportunities, when there are fewer participants in an industry and you have more rational survivors, they're going to be very careful in terms of, again, punching more holes in the ground or fracking, etc. So I believe that there will be more rational behavior by the oil companies themselves. And if that's the case, there's going to be less supply, which should be good for the price of the commodities. And if that's good for the price of the commodities, they will make more money in the future. So we have been, we bought additional shares of Suncor in the downturn. We bought additional shares of Enbridge, the pipeline, which was also down. And we initiated a position in a US company called EOG Resources, which has very high levels of profits, very modest debt, and we believe is going to gain market shares as its competitors go out of business. So it's appealing, but it's, as an investment, it's riskier, so we have to tread carefully.
Right. So if I was to pull from that, how I would perhaps summarize that is you got to do your homework. And so I get this happening all the time. Is I'll have people, they'll come into my office, they want to buy something because they just had coffee with their buddy and their buddy told them about such and such, and so now all of a sudden they want to rush in and get in on the action, right? Got to get in before it's too late. But really, their knowledge of the entirety of the investment, it could be very, very superficial. You got to do your homework.
Well, I mean, that's the reason my job exists is because people want someone to do the homework for them, right? So if you're the type of person who wants someone to look into the company financials, look at the history, make sure that it's a real business that's likely to survive, and if you agree with the process we applied, well, that's why we're in business. I've been doing this a long time, and you've been doing it a long time, and the people who do well are those who are careful in terms of placing their money and who are thoughtful about it and who do it diligently. Those who chase, who act more emotionally. Once in a while you hit a home run, or you might get to first or second base, but often you strike out. And unfortunately, that's again that permanent loss of your money, because you bought something on speculation and it just goes down so much you're never going to get it back. We want to avoid that.
That's good stuff. So let's finish the call up. Let's talk about what is your number one tip for financial success?
I'm glad you didn't ask me for a stock tip, because you always got to take tips with a couple of grains of salt. But for financial success, the people who are the most successful financially have a plan and a strategy. So typically they work with a qualified financial planner like you, Brad. I'm not saying that to be a nice guy or whatever. It's actually very true. You have to have a structure, because if you don't have a structure, you're operating in a bit of a void. You're more likely to make uninformed decisions, or potentially make decisions based on emotion. When you have a structure and a process, and that's what you follow as a financial planner, it's what we follow as investors, the odds of success are in your favor. It's all about tilting the odds in your favor.
Good stuff. Okay. Well, we've got a couple of disclosures that I want to run here. One from Antares and then one from my investment dealer, Aligned Capital Partners. And so they should be coming up on the screen now. I'll just try and make that one a little bit bigger. So, as these things are on the screen, there's one thing that I think maybe I'll just mention super quick, and that's when we have a conversation like that, like this, we are speaking about general information. And there could very well be that any one particular reader's individual situation might vary from the conversation that Alec and I have just had. So as he mentions with the number one tip for financial success, it's important to talk to somebody who can give you guidance and make sure that this type of information does apply to you before somebody would be leaping in and taking action. Alec, you've done a phenomenal job with the Total Equity Fund. I appreciate it. The unit holders of the Prosperity Fund appreciate it. Keep up the good work.
Thank you very much. We're in business because people trust us with their money. And when they trust us with their money, the burden of responsibility to take care of that money as though it were our own is very high. And by the way, my own money is in the same portfolio that you hold in Prosperity. So our interests are very much in sync.
Thanks very much. I'm Brad Brain, speaking with Alec MacIsaac. Take care.